Hi folks, welcome to this cash flow video based on a problem that's in your textbook. So if you have a look at the problem, what you'll see is that we've given you in the comparative balance sheet numbers, we've actually calculated the net change from the beginning to the end of the year for each account. You'll also notice in this question that we have cash and cash equivalents as well as dividends payable. We haven't had this in any other question before. We also have in the income statement, apart from depreciation expense, we have a loss in the sale of equipment and a gain on the sale of long-term investments. These two amounts, the loss and the gain, are also going to affect our calculation of operating activity cash flow. So, before we do the cash flow statement, we'll see that the question asks us in the first part to calculate how much was paid in dividends during 2014. Well, in this case, you have a dividends payable account. Any cash paid is a financing activity because it relates to dividends. So some students would say, well, because I had 800 in dividends payable and now I have 400, that must mean that I paid out $400 in cash dividends. No, it doesn't. You have to look at what was declared and paid during the year. In this question, they didn't tell you that anything was declared or paid. What you have to do is you have to figure out how much was declared and paid. So the way I did it is I looked at tried to reconcile the dividends payable account in order to figure out how much was paid. I know I went from 800 to 400, but how did I get there? Look at what happened in retained earnings. Your question tells you started at $48,160 and ended up at $80,640. Your income statement tells you that you had net income of $60,480. Well, again, when you add these two little fellows together here, you're not going to get $80,640. So what must have happened? You must have declared a dividend or debited retained earnings. So the journal entry you would have made during the year debits dividends declared or retained earnings for $28,000 and credits dividends payable for $28,000. So that increases my dividends payable by $28,000. Well, $28,000 added to the opening balance of $800 does not give me $400. That's because I must have reduced my dividends payable by $28,400 to go from $800 to $400. So the amount of dividends that I paid out is different from what I declared. I declared $28,000, but I paid out $28,400. So I paid out everything I declared this year during the year after it was declared, but I also paid out an additional $400. And that brought me from $800 to $400. So this is the number that they're looking for. Now, in part 2, they ask you to actually do the cash flow statement. We're not going to do this any differently than we've done any other cash flow statement. We have the name of the company, the name of the statement, and the period, which is the year ended December 31st, 2014. We're using the indirect method, which tells us when calculating operating activity cash flow, we start with our accrual-based net income and we convert it to the cash basis. The question gives us our net income of $60,480. So now I have to make adjustments to that net income to convert it to cash. So how am I going to do that? I'm going to look at the changes in my non-cash current asset accounts. Cash and cash equivalents, you remember we talked about this in a previous class. Cash and cash equivalents are both considered cash. So I have to look below cash equivalents for my current asset accounts in the balance sheet area. So if I look there, I've got accounts receivable. Accounts receivable has gone up by $29,680. Well, when accounts receivable goes up, that means that I sold more on credit, which credits my sales revenue more than what I collected in cash. I want to reflect the lesser number. What I collected in cash is less than what I booked in sales revenue. That's how come receivables went up. So I need to reduce my net income by $29,680. And again, if you have a look at your shortcut rules, you'll see here in our case, we had an increase in our accounts receivable. So when we have an increase in a non-cash current asset account, like accounts receivable, which is our situation, we're going to decrease net income to convert it to the cash basis. And that's in fact what we've done here. So now, we've got an increase in inventory. When our inventory goes up, it goes up by $17,920. That means we bought more inventory than we actually expensed to income when we sold it. So that means our inventory went up. The cost of purchases exceeds what we booked as cost of goods sold in the income statement. So therefore, to reflect a higher cost of inventory, which is what we're going to pay out in cash, we have to reduce net income to convert it to the cash basis by $17,920. We also see that our accounts payable decreased. That means that we paid out more to settle our accounts payable than we racked up in accounts payable. So we have to record the fact that, or adjust net income to show that we paid out more than cash than we racked up in accounts payable. If we're racking up accounts payable, that means we're increasing the cost of operating our business, which is reflected in expenses on the income statement. So therefore, we're going to decrease our accounts payable by $96.80. Again, if you look at the shortcut rules, when you decrease a current liability, but not dividends, okay, or anything that relates to financing or investing activities, all right, we're going to decrease net income. So that's exactly what we have here. We're decreasing net income by $96.80 to convert our net income on the accrual basis to the cash basis. Now, we don't have any more non-cash current assets or current liabilities to consider, but we also have to look at things on the income statement that are in that net income amount that have nothing to do with cash. We see here we've got depreciation expense of $24,080, and we see that we also have a loss on the sale of equipment. That loss is $22.40, but don't forget, that loss is not cash, right? Loss is non-cash, so it needs to be added back. Similarly, the gain on the sale of the long-term investment, it's a gain, but it's not a cash gain. It's just a gain on the income statement, and that has to be deducted. So now, perhaps the best way to see how we're handling these gains and losses and why we're doing what we're doing is to go back and try and recreate the entry. So here I'm just going to pop up a document here that shows you how we came up with all of these things and the impact on operating activity. The question told you here that you sold this investment, the long-term investment, for $16,800. Well, if you look at the change in the long-term investment account, it went down by $10,800. So that meant that we credited the long-term investment account for $10,080 and we got cash of $16,800. Well, these two numbers don't leave the entry in balance because we must have booked a gain on the sale of the investment. And of course we did. We got rid of an investment that we paid $10,080 for, and we turned around and sold it for more than what we paid for it. That represents a gain. Can you see where this increase in cash, this is an investing activity. So your investing activity cash flow goes up, right? But the gain in and of itself is not cash flow. Cash is cash. This is cash, not this. But this is sitting in your net income calculation. So we want to adjust net income, not just for any non-cash current asset and current liability adjustments, but we also want to look for things that are in the income statement that are not cash and adjust for those. A gain is not cash. So because the gain increases income, we need to reduce income by the amount of the gain because it's non-cash. So that's why you have us here for the gain on the sale of the long-term investment, reducing it by $67.20. Now, if we look at the loss on the sale of equipment, same logic there. With the equipment, they told us that we sold the equipment for $39.20. It said we also booked a loss of $22.40. We got rid of accumulated depreciation and the equipment at its cost of $17,920. So, again, this is a cash inflow here. So that's going to affect my cash flow from investing activities. But the loss in and of itself isn't cash, but that's in my that's in my net income that I'm using to calculate operating activity cash flow, but it's non-cash. So I have to go back through that income statement and look at anything that doesn't represent a cash transaction, and I have to adjust for it. So whenever you see, your clues are any gains and losses and any depreciation expense. That's all you're going to see. right? In our course, those are the only three things you'll see. You have to adjust your net income for that when you're calculating your operating activity cash flow. Well, losses lower your net income on the accrual basis, but because it's non-cash, we got to add it back. So just as we do for depreciation, we're going to add back that loss, so it's a plus. So we see we have a net cash inflow here from operating activities of $22,800. Now, we've already got information on the investing activity area. The question told us we had $16,800 from our long-term investment sale. That's how much cash we got. And we also got cash of $39.20 when we sold that equipment. Now, we also know from the question that we purchased equipment for $11,200 in cash. So that was an outflow. So our investing activity cash flow was $95.20, and that's an inflow. Our financing activities, we had two. Now look at your bonds, because don't forget, we took in a previous chapter that when bonds are issued, they're just another way of financing your business, because your investors give you cash and you issue a bond. So because we issue bonds, we can see here we did, because it tells us in the question that we issued $14,000 of bonds payable at face value. So when we issued that bond, what we must have done is we must have debited cash for $14,000, and we credited bonds payable $14,000. And because it's a face value, we issued it at face value, there's no premium or discount, so we don't need to set that up at the date we issue it. This is a financing inflow. So that's money we got from our investors that are financing our business, so that's an inflow. So that's there. Now, what about the dividend payment? Well, that's why in part one, we had you do all this mumbo jumbo here to figure out how much of a dividend you're paying. So when we go down here, we know we've paid out dividends in cash of $28,400. So we have a net outflow here from financing activities of $14,400. So when we add $22,800, $95.20, and we deduct, because it's an outflow of $14,400, we know we're going to get a net increase in what we call cash and cash equivalents. So these three numbers added together are $17,920. As we said earlier, cash equivalents are the same, or treated the same way as cash. So we're going to add to that our opening balance of cash and cash equivalents, and that was equal to $14,560 plus $5,600 from your question, so that's $20,160. And it's going to give us an ending balance of cash and cash equivalents at the end of December, which is $28,000 plus $10,080. That's going to be $38,080, which is exactly what we would have expected, because that's our ending balance on our balance sheet numbers in the question. So hopefully you found this cash flow review helpful, and have a good evening.